Hi, I'd like to go over the effects of some of the transactions with you. A. The owner invested $15,000 cash in the company in exchange for common stock. So when you're looking at a business transaction, the first thing you need to do is determine at least two accounts that are affected, what type of account they are, and if they're going up or down. So for A, we have cash and common stock that are affected. Cash, which is an asset, is increasing. It's going up. We are bringing cash into the business. And common stock, which is an equity account, is also going up. Now there's equity in the business. So if we use our chart to record the transaction, we're going to increase cash by $15,000 and we're going to increase common stock by $15,000. On B, the company purchased supplies for $500 cash. So the two accounts that are affected are supplies and cash. Supplies is an asset. It's a resource for the company. It is increasing. We're buying supplies. We're bringing them into our business. And cash, which is also an asset, is going down. We are paying out cash. So notice that when you have two assets, one has to go up and one has to go down because you always have to stay in balance. So if we put the amounts in our chart, you'll notice that supplies increases by 500 and cash decreases by 500. On C, the company purchased land on credit for $5,000. So the two accounts that are affected is land and accounts payable because it's on account. We did not pay cash. Land is an asset. It increased. It went up. And accounts payable, which is a liability, also increased. Notice that even though we do owe money, the account itself, accounts payable, increased. So if we show the effect on our chart, you'll see land increased by $5,000 and accounts payable increased by $5,000. So notice we're always staying in balance. On D, the company completed consulting work for a client, so that's how we earn our revenue, and immediately collected $5,500 cash earned. So the accounts that are affected is cash, which is an asset, it's increasing, and revenue is an equity account, it is also increasing. So we're going to add $5,500 to our cash column, and we're going to add $5,500 to our revenue column. On E, the company completed commission work for a client. So again, we earned revenue because we completed the work, and we sent a bill for $4,000 to be received within 30 days. So our client is not paying us today, they're going to pay us in the future. In that case, we use the account accounts receivable. It is to be received. Accounts receivable is an asset account. It is something of value. So accounts receivable, which is an asset, is going up, and revenue, which is an equity account, is also increasing. So we're going to add $4,000 for accounts receivable and $4,000 for revenue. In F, the company paid an assistant $1,400 cash as wages for the period. Notice when it says paid, that means we're paying cash out. Cash is going down. So our cash account, which is an asset, is decreasing. And expenses, for wages expense, it's an equity account, but it is also decreasing. Expenses decrease our equity. So we're going to subtract $1,400 from our cash, and we're going to subtract $1,400 from expenses. And the last transaction, G, the company collected the $4,000 cash for the amount owed by the client in transaction E. So if we look at E, we already recorded the revenue when we earned it, even though they didn't pay us in cash yet. So in G, all we're doing is showing that they're paying us cash, so our cash will increase, and we are decreasing the accounts receivable. Two assets. Cash is going up, accounts receivable is going down. It's going down because since they've paid us the cash, they no longer owe us. And you'll see here's the balances for each column. So you'll see that we're going to add the columns up. And if we add all of our assets, which are on the left side of the equal sign, and we add the liabilities and equity, which are on the right side of the equity sign, we will be in balance. Each side comes to $28,100, and that's the end of effects of transactions.